Rohr here with another early morning concise highlight on Wednesday, June 25th, 2014. It's currently 6:45 a.m. Central Time, and this will be a concise highlight once again because the foreign exchange still hasn't changed much at all from our Monday global view, although we will be mentioning what's going on there a bit later. But for right now, what we know is that the Monday and Tuesday data on the macro side has been pretty strong, except for Europe. Yet the geopolitical pressures finally came home to roost, both with the continued deterioration of any reasonable country-wide solution in Iraq looking less likely, and that impacted the equities. They finally seem to actualize this factor that we had been mentioning since our question over whether the S&P psych was too bullish under the broader circumstances back in our commentary last Friday. And we also heard from the Fed's Plosser yesterday as well, who was a hawk and not surprisingly mentioned the degree to which rate cuts might be coming sooner than some expect. And looking at what we've seen this morning, though, Japanese corporate service price index stronger than expected, as was a bit of a change in Europe. Both German GfK consumer confidence and Italian retail sales were stronger than expected. The weak spot was in the UK Confederation of British Industry reported sales that were quite a bit lower than expected. And we are looking into U.S. durable goods. The revision of U.S. Q1 GDP that's supposed to drop to minus 1.7, and the advanced services PMI. So shifting over to the short-term view of the S&P, where markets are on the move, sometimes things are actually easier to discuss because the areas and psychology are well defined. While the market held up yesterday around the bottom of its aggressive up channel since the last pullback low in the 1920 area, and that was back in the 1951 area. By later on in the day, it actually broke down from around 1954. And along with the close from Monday having been 1953, this set a short-term daily downside closing price reversal. And what's important about that is this area, rather than nothing up until the more intermediate term topping line up in the 1967 area, can now be considered a bona fide resistance on the psychological turn along with the technical signal. However, it is very important to note that the overrun upside objective and the acceleration on the FOMC influence last week, both around 1938 area, are going to be good support backed up by heavier congestion and, more important, Fibonacci levels into the 1935 area. And we've been mentioning 1935 to 38 as support at any revisit in the last couple days. And that will also turn out likely to be important if the market that is just a hair higher early today, up around 1944, should take some pressure after a modest higher opening, because not only is it those supports, but even though the 30-minute MACD has dropped out below its lower runaway band, the 60-minute MACD still has that potential pending, and not too much below yesterday's low. The market holds, this will not escape, and that'll set up the room for a rebound. If it does escape, then the market might push right down through 38 to 35 and get itself in some bigger trouble. And that's pretty much it for the short-term view of the S&P 500. Moving over to the intermediate term view, you can see that downside reversal is a daily downside reversal. New high up here near 1960, close well back below 53, leaves that. However, you also see other reasons why there are still fairly good lower supports. The first of which is the congestion we're talking about right here into the overrun 1938 upside objective from the runaway gap back at the later part of May on the lead contract, and also the fact that the 18-day average is right here around 1936, and we can see even if that should break, stepping back and saying, well, what's the real intermediate term picture? The swing from the last more significant correction low down in the low 1800s going back to mid-April up to the high, the Fibonacci retracements right around 1920, and over the next couple of days the upward channel off that same low coming up under the market out into Thursday and Friday is going to also be up into the 1920 area. And if the market should overrun, even if it does overrun 1953, we still have our topping line resistance up at the 1967 area for this week.